The question for today is how to maximize your savings into retirement accounts. What are all the things you can do to really maximize the most tax deferred or tax free into retirement accounts so they can grow for the future? And here's the answer. There are multiple accounts you can use to try to maximize savings for retirement. The first is your employer 401k or profit sharing plan. You want to try to maximize that. Oftentimes employers will put in a contribution, a matching contribution, and so you can put in $18,000 of your own money deferred, and also companies can match up to a total of $54,000. And there's also catch-ups if you're over 50, you can do a little bit more than that. So a total of about $54,000 between employer contributions and your salary deferrals. So that is a great way of trying to shove away a lot of money. If your company doesn't do the full amount up to that total of $54,000, also another strategy is, if you can, set up your own company and do work on the side. So contracting work or consulting work or whatever, if you can do that, you can set up your own company and then use that income. And again, you can set up your own small employer salary deferrals and profit sharing contributions and get even more money in that way. Now the $54,000 is across all the places you're employed, all the different plans. So if you're employed by a couple different companies, there is maximums. You got to make sure that you're not going above those maximums across multiple employer plans. All right, so that's one thing, is employer plans, salary deferrals and profit sharing from employer contributions. Another way is the IRAs, your personal independent retirement accounts, Roth and traditional. We've talked about that. And so you can also put in up to $6,000 plus catch-ups if you're older into those accounts. Now remember, they could be maybe tax deductible in the traditional or not tax deductible in the Roth, and there are income limits, etc. But you can always have both the employer account and your own IRAs. So that's the second place that you can put away money for the future. A third place that's often overlooked is your HSA, your health savings account. So if you have a high deductible health plan, then you can put money into an HSA. Maybe your employer does some. You can also do it. And you can put in as a family another about $6,900 into an HSA. Now you can spend that money on approved medical, prescription drugs and co-pays and other things, or you can invest it for the future or do a combination of both. But it's another place that you can put away money tax-free now. It grows tax-free and you take it out tax-free for medical expenses. And so that is another great account that you can use for deferring, for retirement type of planning. So there's just three: employer accounts, personal retirement accounts, and HSA accounts that you can put money tax deferred for the future and really maximize your savings. Have a great rest of your day.